being able to achieve an appropriate ROI on sales and marketing expenditures is the number one way for B2B companies to improve profitability and enterprise value. And the key point here and the take-home point is that not having an acceptable ROI on sales and marketing investments puts so much pressure on business profitability, as well as the financial metrics, as well as enterprise value that impacts an individual stock options in a company, how investors are going to value the company, whether the company can raise the next round or not, and what the valuation will be. It has put so much immense pressure on all those critical business points. Fixing the go-to-market efficiency is the number one way for B2B companies to improve profitability and enterprise value. It's by far the number one expense, and it's by far the number one place where B2B companies are not getting the appropriate return, and therefore is the number one opportunity. Austin's been, I don't know, like May in Austin is like B2B tech conference central. So we had the Forrester conference here last week, bunch of, there's more big companies. So a lot of big company CMOs and events and dinners. I attended the Trust Radius dinner. I attended the G2 dinner, met some really awesome CMOs and had some good connections. So that was good. Now this week is the SaaS Stock USA conference. So SaaS Stock normally has I think it's in Dublin, but they do a satellite event in the US. I think this is their second year in Austin, which was great. I actually spoke at that. I did my speech at 11 a.m., ran through that, got in my car, drove over to the podcast studio, made it here just in time to do this one. I plan to present a similar set of material that I presented at the SaaS Stock conference. It's some of the things that we've already heard on the podcast, but I think the visuals are really helpful. And I think there's some additional new material and data that I think will be helpful to continue to drive home the concept. We've also, based on the feedback, have been iterating on exactly what signals means. I think some people will be pleased with some of the adjustments and enhancements that we've made to the message over the past couple of weeks. And then I'm not sure what else is coming up, but it feels like there's one every week. So I probably got some more commitments next week. I saw some people, and I'm actually on, even though I live in Austin, it's very in my backyard, very convenient, just like hop over to the conference to speak. I saw some people lobbying to make Miami the new tech conference place. And I will say I support that for a variety of reasons. I love traveling to Miami. The weather's really nice there. May is a good time. So we'll see. We'll see if people want to change up. And so with all that said, Sydney, if you want to share, I'll go through sort of like a similar presentation I did at SaaS Stock for people that weren't able to attend live. And I don't think they recorded it, so that raw talk won't go on the podcast. We'll use this as a way to do that. I'll run through some of the key data, some of the concepts people have already heard. So I'll pass through those rather quickly. And then we'll get into the normal Q&A discussion, learning. Hopefully this sparks some questions and some ideas. Cool. So I've been, along with Kyle Coleman, who I'm going to have some coffee with tomorrow, have been talking a lot about this concept of go-to-market bloat. We have similar definitions of what this actual business problem is. So I'm going to elaborate on that business problem. But then we also approach how to solve the problem in very different ways, and I think complementary ways, which I think is unique. So let's go through the concept of go-to-market bloat, and then we're going to get into unified pipeline architecture and then signals. So I presented some of the data around public SaaS company data a couple of weeks ago in terms of sales and marketing expenses and the payback of sales and marketing expenses against net new revenue based on the growth rate. I connected with David Spitz, who's doing a ton of great work in here, and have actually expanded that data set to not only look at a point in time of like 2023, but to look at the trends of this over the past, 4 or 5 years. And so you can see the trends here. Public SaaS median growth rate by quarter has slowed by more than 50%. And you can see that sharp decrease somewhere around 2022, mid 2022, from around a public SaaS company average, the median at about 40% year over year revenue growth, which is massive for public companies and the amount of base revenue they have, now down to a median of 18%. And so when you have growth rate compress and you're trying to hit rule of 40, or you're trying to have some, enterprise value, and how enterprise value is calculated not only as a multiple of revenue, but potentially a multiple of free cash flow or discounted cash flow, that the entire P&L and the entire way that you need to run your business changes when you're growing at 18% instead of 40%. And so this is a huge trend. going on in the public markets. I'm going to talk about how it's impacting the private markets next. Again, public company data. The reason I start with this is because this data is transparent. Public companies have to report this data on an S1. Now you look at public SaaS median sales and marketing percentage of a net new ARR, which is basically the inverse of CAC payback period. So if you see 100% here, that means it takes 1 year to pay back the cost of acquiring a customer. If you see 200%, 2 years, 250%, 2.5 years. So you can see that CAC payback period or sales and marketing percentage of net new ARR has increased by almost 100%. Specifically, again, you see that sharp increase in around 2022 to a level where now the median sales and marketing percentage of net new ARR is about 250%, which means it's 2.5 year average CAC payback period. And this data mixes in expansion revenue as well. So this is expansion revenue, and it's actually more generous than most companies that look at only net new ARR. And then we've shown this chart before, but just to hammer home the point, in public companies that are growing less than 25% year over year, which a majority of them, 58 out of 80 companies, so a majority of the public SaaS companies are growing less than 25% and have a CAC payback period of somewhere between 2.5 years all the way up to more than 6 years. And then the point that I want to make here, Sydney, as we move to the next slide, is that this data is, these effects are even more amplified in private companies. Yeah, these trends are even more amplified in private companies, that private companies do not have massive market share already. They do not have a significant, large, current customer base that they can get expansion revenue from. And then there's word of mouth in the market and things like that. The public companies are the cream of the crop because it's almost a selection bias because they've already gotten there. And so when private companies that don't have some of those advantages, these types of trends in terms of growth rates slowing are more pronounced, and CAC payback periods even more pronounced, to a level where there are many companies that are cutting their sales team in half, that are cutting their marketing expenditures in half or more, that are potentially getting rid of their either entire SDR team or a majority of the SDR team. And that's been happening slow. It wasn't like one big swoop. That's been happening over the past couple of years. And so these trends are very amplified in private companies. And the data that we look at Paceto, with more than 50 companies in private, mostly mid-market, $30 million or more in annual recurring revenue, that we see these trends significantly more amplified in those types of companies. And so let's define this. What does this all mean? CAC payback periods going through the roof, growth rates slowing. What does that mean? It creates go-to-market bloat. B2B companies invest tons of money in sales and marketing, on average somewhere between 40 or up to 60% of total revenue, and do not get anywhere close to an appropriate return on the investment. That sales and marketing expenses are by far the largest expense on a B2B company P&L. That they'll spend 2 to 3 times more on sales and marketing than they would on product development, engineering, and R&D combined. And that go-to-market bloat is not just around spending too much money on Google ads or spending too much money on events. It happens in programs, in people and headcount, and the over-specialization inside of people and headcount. The low sales, quota attainment is an impact of having too many people, having too many expensive processes in how we report or how we follow up on a MQL or all these different expensive processes, as well as technology, where companies just have massively accelerated and increased their technology stack to a level where they just spend too much money on all of these different things and do not get the appropriate return. And the key point here, and the take-home point, is that not having an acceptable ROI on sales and marketing investments puts so much pressure on business profitability, as well as the financial metrics, as well as enterprise value that impacts an individual stock options in a company, how investors are going to value the company, whether the company can raise the next round or not, and what the valuation will be. It has put so much immense pressure on all those critical business points. And there's been a shift. People have been talking about this for years. I love that Sam Jacobs has been championing this for a while. Sam Jacobs, CEO of Pavilion, the shift from growth at all cost into profitable, efficient growth, where valuation multiples have compressed, where before it would be, pretty standard to have a company raise a Series B at somewhere between 20 and 50x revenue multiple, where now public companies are trading somewhere between 4 and 8x, and private markets sort of follow that trend. That growth rates have slowed significantly, both in the public sector, which I've already shared, as well as in the private sector, which most people know if they're in those companies, and we know because we look at the exact data. And that puts significant pressure on a company's ability to hit Rule of 40 and have positive free cash flow. And that fixing the go-to-market efficiency, being able to achieve an appropriate ROI on sales and marketing expenditures is the number one way for B2B companies to improve profitability and enterprise value. It's by far the number one expense, and it's by far the number one place where B2B companies are not getting the appropriate return, and therefore is the number one opportunity. And so now we get into signal-based analytics, which I believe fully is the fastest way to optimize go-to-market investments. We have closed out many projects with companies that are 100 million, 200 million, 300 million ARR, and been able to track the impact from one quarter into 90 days later and see incredible impacts on just making key changes. Some is cost cutting, some is reducing programs, but also in pipeline growth, in sales velocity. This is not just a cost cutting method. It's also about figuring out what are the things that are actually working, leaning into them and making them work even better. So it's on both sides. We need to be able to reduce costs and we need to be able to improve the effectiveness of what we're actually doing. Signal-based analytics gives us a very fast and clear path on how to do that. People have seen the bow tie framework. This is effectively a simplified version of the bow tie framework, but we have the net new acquisition process where we need to get our target accounts in market and interested in buying. Then when they show intent, we need to capture that intent. We need to convert that into a closed won customer. That's the net new acquisition process at a very high level. And then the expansion renewal process, we need to onboard the customer. We need to achieve the impact that customer desires. Then we have expansion renewal upsell. Very simple growth process. And the point here, and a lot of the data that we have is supporting this point fully, and I can't wait to have clear benchmarks to be able to communicate this with even more data, but converting an in-market account from in-market to revenue, aka signal, sales action, all the way to a net new customer and revenue is the most expensive process in a B2B company by far. And we're going to illustrate this in the next slide. That right there, account is showing intent or person showing intent all the way to a closed won customer, up to 80% of the total sales and marketing investments are deployed there. And that includes the investments that gets spent on customer marketing, on brand, on account management. All those things are outside of that part of the process. But just inside here, you have 80% of the marketing investments, performance marketing, lead generation, Google Ads, most of the event budget spent there, most of the headcount deployed there, most of the agency resources spent there. Then you have all the SDRs, MDRs, BDRs, however much the company will specialize. Then you have sales resources, solutions consultants, junior AEs, enterprise AEs, sales ops or rev ops, marketing operations. There's so many expenses that are just queued up at this micro part of the process. Companies dramatically overspend here and do not get the appropriate return. Signals, I'm going to pass over this slide rather quickly because everyone sort of knows this, but we've made one key enhancement here is that signals are every single trackable signal that happens. And the buying signal is the signal that happens where sales takes action. So it's been able to segment. Thank you, David. Yep, I can see you rocking over there. Isolating that because you're going to have thousands of signals that your sales team isn't doing anything with. And then when sales is taking action, that becomes a buying signal. And that's when you start being able to track that through the process, which leads you to millions of data points and really clear data about what shit you're doing that isn't working at all. And what are the things that are actually working that we should do more of. So that was one key enhancement here in the signal definitions. Signals come from first-party and third-party sources. The historical way of companies looking at this was, okay, all the first-party signals are MQLs, and then all the third-party signals is sales doing outbound, and the data is not tracked comprehensively. It's not tracked anyway, and so you just have these two different things, and we need to be able to bring them together, unify the data, look at all the available signals, get out of the inbound, outbound, or marketing sales conversation and say, here are all the available signals for our go-to-market. How should we deploy our investments and our effort to get the best return on our entire go-to-market spend, not segmenting it out by department? The unified pipeline architecture allows us to connect all of these things together, where before you have leads and contacts and MQLs, which is the marketing data, and then you have meetings and things that happen on the leads or convert to contacts is what the SDRs do. And then you have opportunities is what sales works. And you have campaign members that comes from multi-touch attribution that you try and stitch all this stuff together. And it just doesn't work. And then, you have 7 different people and then you have finance all trying to run reports and you don't have anywhere near any type of comprehensive or accurate way to look at it, no consistent way to look at the data. And so what happens? You spend most of the meeting arguing about whether the data is accurate or not trying to solve the business problem. And so the unified pipeline architecture basically extends the definition of what pipeline means, where pipeline starts at the buying signal, not when the opportunity is created, and creates so much more granularity at that part of the process to understand how to optimize. signals really matter. These are 3 different examples when it comes to sales velocity and revenue. But in a normal company, you'd have hundreds or thousands of discrete individual signals that will have their own revenue and sales velocity profiles. They create clear data around what are the most effective things that we should do and what are the least effective things that we should stop doing. And when you look at them and you look at all the things individually and the best performers and then the not best performers, what happens? You say, oh, that's common sense. And so the data supports what would be common sense, which I think is a good validator here. And across almost every company, I think it might be 100% of companies, we've been able to demonstrate in their data that sales productivity can vary by over 100x depending on the signal, which means that if you're able to isolate the signals that work, that your sales team needs to do 100x less actions to generate the same amount of revenue, and likely at a much higher sales velocity, which compresses the amount of money that you have to spend, and it compresses the focus, and it gets rid of some of the ancillary technology that you don't need, and it gets rid of the processes and reporting for shit that doesn't work. And that's really a key insight about why signals really matter. And then most people on this show and that listen to this podcast know, like, for most signals, the outcomes of the signals are mostly untracked. Sure, Demandbase writes the data to your account record. Sure, 6 Sense writes some data to the account record, but you're not able to easily connect that to the entire process, report on it, and make decisions. And so there's a difference between logging an activity versus setting it up in a place that we can report and make decisions off of, which is the key thing that's missing. First-party signals that typically are known as MQLs or come from marketing automation are sometimes tracked, but from our experience at Paceto, a majority of them are not tracked comprehensively. There's not enough data on them. We can't connect advertising or other places where we deploy money to trigger it against signals. And it's just generally not comprehensive or not complete. That outbound is an entire black hole that our sales team is just getting a variety of data, maybe cold lists or target account lists or some intent data from someplace, and they're just doing stuff, and none of that stuff is being tracked. We're able to administer the comp plan. We're able to understand who is sourcing the meeting or who's closing the deal, but we have no insights about how to make it better or why it's happening and why the data looks that way. That intent data providers, account-based marketing platforms, let's go back one. Intent data providers, signal aggregators, account-based marketing platforms, and other tools like that provide the signal data don't actually measure the outcomes of the signals. They're in the business of providing you data, but not measuring the outcomes of them. So sure, your sales team can use them. Sure, they're going to make a case about why it works better than what you were doing before, but you're not able to then continuously optimize based on that data to say, okay, inside of this, what are the things that we should actually be doing and how do we make it better over time? And then a key point here is that if you don't track signals, that you basically have no data about all the times that your sales team does stuff and loses. And in a normal B2B company, 99 out of 100 times, up to 99.9 times out of 100 times, your sales team is going to take an action and lose. And that's the place where we're going to drive a lot of go-to-market efficiency, is not doing all the things that clearly don't work based on data. And then quick recap here, and then we'll get into questions and other discussion topics. So there's been a clear transition from the growth at all costs era to profitable, efficient growth that's driven by the economic environment and how investors are valuing companies and deploying capital, which requires fundamental changes in how we develop our go-to-market strategy, how we deploy investments, and how we evaluate those investments. That go-to-market bloat is by far the number one issue on a company's P&L and creates massive opportunity for the companies that can figure it out to be able to consistently accelerate growth while also reducing costs to fix this go-to-market bloat issue. That signals provide clear, obvious insights for how to optimize these things, but are mostly untracked in a B2B company today, so they don't have this obvious data to make easy decisions. And that the platforms that provide the signals are not in the business of measuring the outcomes of the signals, which is something that I'm trying to hammer home, because buying 6 Sense or buying Reggie AI or buying Common Room is very different than being able to use that data to make decisions around how to optimize how you use those tools. And we need to have clear distinction between getting signals and actually measuring the outcomes of the signals. And the last slides, you know how to reach me, but there's some QR codes that I presented at the presentation. That was the overall presentation at SaaS Talk. There was a bunch of people taking photos of especially those first couple slides from the growth rates and the CAC payback periods from public SaaS companies, because that is the core root of the problem. This is bigger than how do we optimize our Google ads or what agency should we use Or do we, how do we optimize our SDR outbound? This is a much larger problem that is now at the level of the board and the CEO and the CFO. And ironically, a lot of the conversations that I've been having recently over the past couple of months as I've been talking about this are really CEOs and CFOs that are coming to us to solve this issue. And so being aware of that as a consultant or an individual contributor or a team leader inside of one of those revenue functions, to be aware of what's happening at the board level and what your CEO cares about, I think is fundamentally really important and really insightful for you to have. And so those are the conversations, especially companies that have some scale. Maybe they're owned by private equity, or maybe they're trying to get to an IPO. Companies that are further along really need to start to fix this equation in order to set themselves up to make it all the way to an IPO. So with all that said, looking forward to some further discussion on this. I love the topics and discussions because it helps. You can see the iterations and the improvements that we've made so far. Thanks to all of you showing up and helping us get there. So looking forward to another great discussion. Thank you all for being here.
All right. We've got like 5 or 6 questions queued up in the chat has been going off. So first I'm going to bring on Chris.
Hey, good afternoon.
Good afternoon.
Good to see you again. So Chris, my question for you, and I'm starting a new role where we're starting to put in place some of this, and it's new news for a lot of people, which is great. They're super excited. The question is, when we talk about CAC paybacks, the marketing spend, for it is what it is. And then, I'm looking for a rule of thumb. For every $1 of marketing spend, you typically will see another, if I reverse engineer all the math out of all the ways you've talked about this, it sounds like about $2 to $3 of additional sales SDR spend for every $1 of marketing spend that gets put into that kind of overall CAC payback period. Is that the right range that I should be thinking about?
I can tell you what we normally see. I can't confidently say that's the right way to deploy it, because I think that companies, based on the performance, there's a clear imbalance in how the investments are allocated across the entire go-to-market. But historically, what we see and traditionally what we see is at the most generous, like we've seen one time where a company will spend 50% on marketing and then 50% on sales. So that's the lowest end, 1-to-1. But generally, you'll see up to 1-to-2. Where they'll spend 33% on marketing and 67% on sales. But there's some nuances here. Do BDRs go into the marketing budget or the sales budget? And so there's some nuances around how those are calculated company by company. But I would say that's the general range, somewhere between 50 and 67% spent on sales, and then the remainder would go to marketing. I think it's even lower at some. In a more traditional company, it might be all the way down to 18-20% on marketing and 80% on sales.
Yeah, that makes sense. Okay, that's very helpful. Thank you.
All right, we're gonna queue up Casper next.
By the way, really interesting slides you just showed there, especially with the growth rates. So this is all based on public companies. So my question is, if you have any benchmarks on the CAC payback periods for private companies, and also an extension of that question is, how does a company, how big of a percentage does a private SaaS company usually spend for sales and marketing compared to the total revenue?
Yeah. So I'm going to create 2 distinctions here. So first, there are multiple ways to calculate CAC payback period. So public companies look at it and they include expansion revenue and net new revenue, net of churn, right? So in NRR, if you expand $10 million in business and you churn $5 million, you'd have $5 million in net ARR from expansion. And then you have all the net new business, that all gets combined. And then all the costs, including the expansion side, so typically customer success and account management, also get included in that figure. So that's how public companies will report on it. Many private companies will segment it and only look at net new. And so they'll try and allocate the cost around what are the things that we spend on to acquire a net new customer, and then only the net new revenue, and they'll look at it that way. So there's just a distinction there because there's nuances in how it's calculated. There's not really benchmarks or typical things that you see in a private company because it's dynamic. I was having a conversation with a company a couple of weeks ago, And in 2021, their CAC payback was like 24 months. And then all of a sudden, all the costs increased, net new ARR went down, and it inflated up to 58 months. And they had to do large cuts on sales headcount and marketing and things like now. And now it's back to 19 months, right? So it's very dynamic, where if growth rate slows, then the only way to get it back is basically to reduce costs or accelerate growth. Most companies are not finding ways to accelerate growth dramatically right now. So the way to get there is through cost cutting, and then it comes back down. So you can see a range here of like companies that have been able to make those adjustments might be somewhere between 18 and 30 months. And that's probably like what you'd consider a high performer in this category right now. And the companies that are late to making those adjustments could be well above 60 months. And so it's a very large range. And I think that we should, when I do this, I'll caveat and say these are more mature companies. I would say 30 million ARR plus. The data gets very skewed for lower, like, earlier stage companies because they don't have a lot of base revenue and they don't acquire a lot of revenue. So the amount they spend to acquire a customer gets outsized. And then when it comes to percentage of revenue spent on sales and marketing, I would say an average is typically somewhere between 40 and 55% for a mid-market company. And that's also reflected in public company data, perhaps because the private companies just do the same thing that public companies do, or perhaps they're getting benchmarks from someone that I don't know about that tells them to spend that much. I'm not exactly sure why, but generally right now you'll see somewhere between 40 and 55% of revenue spent on sales and marketing, which I personally believe is far too high given the growth rates and how much net new ARR companies are adding today.
Okay. Yeah. So also, basically with this whole go-to-market bloat, one of the things is not just to like maximize the investments the investments from marketing and sales, but rather like actually reduce it while still getting the same results or better results.
Like there's two ways to basically improve this thing: get more customers for the same amount of money, or get the same or more customers for less money. And the two ways that you get there is by cutting the things that clearly don't work. That's the number one way to get there. And so you have technology that doesn't provide ROI. You have processes and meetings that do not provide ROI. You probably have too many SDRs or MDRs or specialized like sales development roles that are not providing appropriate ROI. Companies definitely spend too much on marketing programs that do not provide ROI, specifically large-scale trade show conferences and events and digital performance marketing. Then you have, sales quota attainment on average somewhere between 30 and 35 and 45% right now, which means that theoretically, you should have 50% or more less sales headcount. And so all of those things become places where you have go-to-market bloat, where you spend too much money and do not get the appropriate return. Meanwhile, there's a bunch of things that companies do that provide incredible ROI. We see incredible ROI on webinars. We see strong ROI on like intimate type of field type of events and dinners. Incredible ROI on some organic strategies, whether that's SEO, organic social, non-conversion based paid social, having a podcast or other types of content that are driven through that. Some companies getting much better ROI using AI to drive a lot of their outbound and having just significantly lower costs and the same or better effectiveness. So you have all these things where, hey, we could, here's things that are already working. Let's figure out how to do more of them and make them work better. And you just have both sides of that equation. So ideally, you're lowering costs and you're increasing pipeline and revenue. And this problem, the magnitude of this problem is so large that you really need to play with both sides of that spectrum in order to really solve it. Great question.
Good to see you again, Casper. All right, Alex, coming to you next.
Right. So thanks, Chris, for sharing all those insights. I love the discussion. I've been a student of the Vault for quite a while now, and for sure, like I really love the hero concept about defining what's true pipeline. And I was listening to your podcast this morning, and you talked about it in the last few minutes. Also, that pipeline begins with the buying signal. So I just wanted to clarify, like between the hero stage and starting from the buying signal. Like from my point of view, I would understand that the buying signal could be like maybe before the hero stage as well. So I just want to have like your thoughts just to clarify this point in terms of like what is true pipeline actually?
Yeah, great question. So Hero is used as a way to normalize a company's definition of what qualified pipeline means so they can improve forecasting and also improve where they get their pipeline from. They have visibility to that. And so that's really the goal of using a Hero definition across your entire go-to-market. What I'm saying about where pipeline starts is really about having the data layer to track the entire process, which right now happens across many discrete objects. And it's very difficult to put it together to understand what's actually happening. And then you have to use cross-object reporting or pull it out in Excel and start doing filtering and manipulation in Excel. And then all of a sudden you have someone in different departments in the finance department all trying to manipulate this shitty, disconnected data, and nobody gets to the same conclusion. So you spend more time arguing about the quality of the data or how it was analyzed rather than just being able to make decisions about where to go from here. And so the point on pipeline is just thinking about, because like if you look at like a Clary or some type of sales forecasting software, they only look at the opportunity object. The problem is that all the stuff that happens before has a massive impact on the ability to forecast from when the opportunity starts. And we really need to be able to connect all that stuff together. So when you think about where pipeline starts, and when I say that, it's really about having a connected data layer across the entire process.
Thanks.
Right on. Thanks. Good question. I'm happy to clarify that point.
All right. Mason is back this week again for another question.
Yes, I'm back. Glad to be here. So, Chris, it's traditionally, I think it's known across, B2B SaaS. It's a little bit less expensive to upsell and expand existing accounts than it is to get net new per market. And given the trends that you're seeing across private and public SaaS, with CAC growing up and growth rate slowing down, do you think that there is a rebalance that's needed to invest maybe a little bit more in expansion/retention? And if so, like what would that play sort of look like? And how would the signal approach maybe differ for that versus net new acquisition?
Yeah, so just to be clear, like growth rate is a combined metric between net new ARR and expansion revenue, and growth rate is slowing. But if you break it out to NRR is declining and gross revenue retention is declining in most companies as well, right? So that used to be 120 and now is 108 or something like that, right? So you're seeing the same decrease as companies are scrutinizing all their investments more frequently. They're looking at consolidating technology or eliminating technology from their stack. They're cutting agencies and fractionals and other things in order to get cost savings without having to do another layoff or remove staff. So they're evaluating all the investments, which is driving down both net new ARR acquisition and NRR. I don't have like a ton of data around this yet, but my intuition and my gut says that companies should be allocating. They spend too much money on how do we get a net new in-market account to become a closed won customer. And those investments should be spread out more, where there's more investment going into expanding and making customers successful, as well as more investment going to getting net, target accounts in market to buy through demand creation motions and just being able to rebalance the budget across the whole customer lifecycle. We'll have more data to support that in the future, but that's what my intuition is saying. The signal concept can work for both a net new customer and an expansion customer. Like if you have a cross-sell opportunity or you have an expansion opportunity, those accounts are sending you signals. Maybe they're in the product though. Maybe they're, maybe it's a different level of a signal. Maybe they're attending an event that has to do with a new product or a new part of your platform that they don't really use right now. Maybe it's a different department that's now on your website or a different person that's on your website looking at things. So you can use the same exact signal concept and the same pipeline architecture. All that's changing is the opportunity type is not a net new customer. Now it's a current customer or an expansion or cross-sell opportunity. But the same process can work right now. And the ability to understand why you're expanding customers is a total black hole right now in companies' data. They have no idea why. They know that companies are expanding. Maybe they can attach some product data in there to try to understand it. But really, it's just someone's unearthing an opportunity and they're closing it. There's not a lot of science or data around why or how do we get more of this to happen. And so I think that signals provided a strong opportunity, at least to have that more of that data collected to understand the impact and therefore be able to understand how much more or how much less should we spend on that part of the customer lifecycle.
All right.
We're rocking.
Yeah, we've got some queued up here, so I'm just going to keep it rolling. All right, Danielle is going to come on next. Here's another question.
Hey, Chris. Thank you for this really great presentation. Just a easy question. Are you seeing this beyond SaaS, these
I
trends?
I think that slowing growth and like concerns around having enough pipeline to hit growth targets is impacting more than just SaaS. And so, I think financial services and manufacturing and, industrial and potentially government, I think that it's impacting other areas in terms of the ability to close more customers. The thing that isn't as pronounced is those companies never dramatically overspent on sales and marketing like a tech company did, because they didn't have the revenue multiples to ever get to that problem. And so the overspending, I think, is very isolated in tech and SaaS, and the magnitude of the spend, which just makes the problem a lot more pronounced. But I think that almost every industry out there is facing slowing growth and less customer acquisition right now. Even if you look at direct to consumer and other things, those places outside of even B2B into the consumer discretionary spend is definitely down over the past year or two. Real estate's getting fucking destroyed. So I think it's impacting a lot of other places outside of B2B tech. But when it comes to go-to-market bloat, you have two parts of the equation. How many new customers or how much new revenue do you get? But the other part of the equation is how much do you spend? And the how much do you spend part of the problem is very pronounced in tech and SaaS companies. Any follow-up there?
Well, it's interesting because I'm just trying to like problem solve what's the root, is it? And it feels like if you could look across more industries, you could see, is there an issue with, is it just like inflation? Is it just, the economy is depressed, or is it just that people, it's just harder, like things are just more difficult now? I don't know. It'd be interesting.
I mean, the clear root cause is the change in interest rates. So that's where it starts. And then when the interest rates go from, negative interest rates or 0 or 1, 2%, whether it's for a mortgage or any other type of thing, up to 5, 7, 9% in that area, then what happens is investors change how they deploy capital and banks change how they deploy debt. And then all companies out there and consumers have less availability to money. So then their wallets tighten, and then all the people that sell to those people now have their wallets tightened. So the interest rates are definitely the driver. The only way or I don't know about the only way, I'm not an economist, but it seems like the clear way to slow down inflation is to increase interest rates and slow down consumer spend. And so that's the core root of the issue. And I'm not sure we'll ever get to a level of interest rates that we were before. Again, I'm not an economist, but it seemed there's just too much printing of money. And then it's just when you have a really large machine, like $1 billion company or a $200 million fast growing company, it's just that you can't solve these problems overnight and you can't predict the future. So people thought, hey, it's going to be bad in the middle of 2022, but how long is it going to be? How bad is it actually going to get? When is it going to be better? And then their revenue doesn't fall overnight. It falls slowly, especially companies that have annual contracts or multi-deal contracts. And so it's actually a slow and consistent process rather than one fall swoop. Like there's many companies that have had to do a layoff in 2022 of 20% and then 15% in 2023 and then 8%. Indeed just did that yesterday, laid off 1,000 people. Eventually you hit a bottom, you bottom out, and then you stop going down, you start going back up. And some companies have been feeling that for over a year. Other companies, I think a lot of companies felt that somewhere in 2023, but they just quarterly reports came out for Q1, and also the overall economy reports came out in Q1 and did not show great data. And so I think a lot of companies, based on that data, you're going to see, sadly, and I'm not here ambulance chasing, I try not to be, I just try to be objective. I think we're going to see more layoffs happening in Q2 and Q3.
All right. So this question is from Kelsey. She had to drive, but she's a regular here. Said she'd listen to your answer after this goes live on the podcast. She said, I'm curious what sort of resistance you hear from business leaders on signal-based approach and measurement. It seems logical. I'm curious what the devil's advocate might say, or what clients push back on.
So a couple of the like devil's advocate approaches, people that are very obsessed or have been brainwashed around this idea of multi-touch attribution, which by the way has value and solves a different problem than what a unified pipeline architecture solves. So it's not an either or, it's both. And they actually solve different parts of the process. I think multi-touch attribution is most valuable before sales takes action, right? It's going to track 100 touch points before sales ever does something. But then when sales does something all the way down, that's when signal tracking really matters and provides you with clear data. So it's not an either or, it's both. But a lot of people will say, well, these 17 other things happen before you track that signal, and those things really matter. And maybe they do. Maybe there's value in it. But what's clear to me is that if you just use the signal, you have clear, obvious insights that match exactly what multi-touch attribution would tell you. It's just more pronounced and more easy to it's more easy to figure out. We have companies that use a W-shaped model and look at a U-shaped model and look at signals, and they all lead you to the same conclusion. It's just that it's a much easier to see the conclusion with signal tracking than the other models. This like multi-touch complex buyer journey would be one place where you have like devil's advocates or pushback. Sydney, what else is there? Like I don't think there's actually a lot of people that are pushing back on the concept except for that key point. It's just early. Like a lot of people don't know about it and a lot of people haven't tried it yet. Other people will say, well, we already track that or we already do that. We have a BI tool. We pull it out. Like we do all this gymnastics to get to that level of data. And I've only seen like a top echelon of 2 to 5% of companies that can really pull it off with their BI tool and their like ops and CRM implementation. And most companies like think that they're doing it or think that they're following the best practice, and they're not. But generally, I just think it's early and the market needs a lot of education, and it feels like things move fast in B2B and tech, but things move really fucking slow. So it will just take some time. The benefit that we have in this situation is that the financial pressure will accelerate people looking for new solutions to be able to solve these problems, whether that's someone that's going to start an agency around this or have a fractional or build a technology for it or, work in-house and try to get this go-to-market strategy role that I've been talking about to actually solve this problem. It's just going to put pressure and accelerate companies looking for solutions because the existing ecosystem and the existing solutions do not give a clear path to fixing this part. If you look at all of the marketing attribution and all the marketing analytics tools, they're all biased to show how good marketing's working. Even if you look at the SDR side, all the analytics solutions are bottoms-up analytics solutions built to help you prove that things are working. And we need a whole new category of stuff looking at what are the things that aren't working. And I think the unified pipeline architecture is the clear, most obvious way to track signals, clear, most obvious way to get the data around the things that aren't working that then allow you to, create somewhere between 30 and 50% of your total investments on go-to-market that you could see, hey, these things aren't working, and then be able to cut, reallocate, change. Yeah, that's what I would say about where we are with this, with signals in this concept.
Yeah, I'd add on, there's actually a lot of appetite specifically from ops, analytics, data teams to prioritize this and solve this need in the organization. They just need the leadership to help them prioritize that. It has to be an initiative that's prioritizing the business, not necessarily an initiative that is just prioritized for one area or a couple sprint points for this person's team over here to work on a component of it. So that's kind of what we're seeing with clients and helping them through that process. The other, I wouldn't call it pushback. It's more of, I buy into this idea of signal-based selling and looking at signals holistically, but how do I get the team alignment if they already have poor marketing and sales alignment? Which, that's a whole nother issue if you already have poor marketing and sales alignment. But I actually see this as a way to like foster that alignment and say, this is a new way that we are going to measure things, look at the funnel. It's not credit. It's not compensation based. People aren't getting fired off of how many signals they, generate or work, and kind of take that approach. So that's just a little bit more qualitative feedback for that question. All right. Now we're going to go to Erin.
Hello. I love Sydney what you shared there. I feel like it's kind of similar to what I was inspired to kind of riff on in our chat, and what I'm kind of going to discuss hopefully with Chris. I think people often underestimate the challenges with duplicates and quote unquote keeping the data clean, especially across a decentralized tech stack, and an increasingly complicated tech stack. So I'm talking a company that maybe added on PLG, has maybe gone through a couple of mergers or has done a rebrand, or maybe all of those at the same time. I find that especially with leadership, they really underestimate the consequences of not tackling that head on. And so it almost creates this chicken or the egg situation, because you've gone out and you've told your marketers and you've told your sales teams that a part of their compensation depends on getting X number of MQLs or X number of SQLs. And so there becomes this kind of conflict internally of trying to get buy-in to change things when you're not able to get it top down.
The only way to
Right.
solve this is top down.
Right.
Yeah. I appreciate your perspective, and I know that rings true for a lot of people. And even if I look back to my career before I started my businesses and I worked as an employee, like I was championing, it wasn't this exact change, but I was championing changes as a senior manager or director, and getting basically nothing done. And when you champion transformational changes, it's easy to champion buying a new technology. Like I was able to get the company to buy HubSpot. I was able to get the company to buy a sales forecasting software. It's easy to champion like a technology platform, but when you champion changing how we forecast our entire business and how we run our financial model and how people across our 100-person sales team get compensated and how our go-to-market team overall, when we try to align incentive structures and compensation across marketing and SDRs and sales and account management, those are really only things that can be top-down changes, which is tough. It's tough. It's tough to be in that position as someone that wants to make these changes happen, but not be in a position or have the political capital to be able to get it done. And so those situations are tough. It leads you to say, should I go to a different organization that the executives have already made these changes so I can participate in a company that runs in a different way? I will say that in every company, there's things to learn. And the accumulation of the skills that you develop over time are actually the things that provide the most value to you long term, is actually the skills and experience and the things that you learn about how did this company operate? What was their leadership rhythm? What were they reporting in QBRs? And if I observe very closely, what were the core issues inside of how they were doing things? You can see how a company runs, and you can see all the things that you like and all the things that are good, and you can see all the things that you don't like, and you can try to understand why are these things happening or why aren't people prioritizing solving them. And if you take the mindset of, I'm trying to really just ingest and learn because I know if I'm able to develop these learnings that it'll pay off for me in the longer term. I think that's it's tough to operate, but it's a good mindset to have. And it can be really frustrating at times. Many times I wanted to quit the companies that I worked for. And many of the times I look back and say, I'm really glad that I didn't. Because I was able to build additional skills and build a story around the impact that I made at a company. It's really hard to make a real tangible impact on a company in 6 months. It's really even hard to understand your market in that level of time. And so we need to pick companies where we're able to have a longer tenure, where we're able to have years of data around the impact that we're able to help the company make or even individually drive. And so I think from a career perspective, there's a lot of people that hop around jobs and don't stay at one job long enough to build stories around their impact or actually build real tangible skills and experience. And I think that's it'll get you to a certain level, but eventually you'll be exposed at a level where it's like, hey, you jumped around senior manager, director, senior director, VP, and you made that jump over 4 years by changing companies every year. But then you're in the VP role and you really don't know what you're doing and you get exposed. And so that Aaron, that has nothing to do with your question. I just kind of went on a rant there, but wanted to provide a little bit of career advice. Yeah.
I appreciate the rant. I don't disagree with anything you've shared. I think the political capital piece has always been the most challenging for me personally. And I don't know if it's true. I mean, I would imagine it is. I think part of it is, especially when you're in ops, it's a very highly matrixed role. And so you're spread even thinner. And that for me makes it even more challenging. But I just can't quit.
Yeah.
I feel I take it as a personal failure when I just can't get more influence and can't get people to see the problems for what they are. But the worse the data is, it makes it even harder to convince people. And I think, is contributing to that as well in the form of hallucinations and things like that. And then if you don't have really good sysadmins that know how to put in place observability and really great like SRE, you're just in a tough spot.
Yeah, I mean, I got to say that whenever I worked at a company, like, I got some things done, I had some accomplishment, I put some wins on the board, but I didn't get any of the transformational changes that I championed anywhere close to really getting done inside of a company when I was an employee. And then all of a sudden, I go out and I start talking about the things that I know, and I'm doing it on LinkedIn. And then people are literally knocking at my door to hire me to come help them solve all the things that I couldn't get done at the company that I worked for. So I'm not recommending that to you. But I think it's a really interesting, it was really interesting for me because I was literally saying the same thing as an employee at one company. I was just saying it to the wrong people.
Mm-hmm.
The people at that company did not want to buy, quote unquote, do what I was selling, pitching. And then I started just pitching my ideas to the world. And all of a sudden I started attracting people that actually loved those ideas and wanted to implement them, and hired me and paid me a lot of money and actually listened to me and followed through with the things that I was saying. And so again, not recommending that to you personally, but that was a huge insight for me because I literally said the same thing. It was just who I was saying it to.
No, that's a great insight. And I've tried to, I think, take that in and recognize that there's opportunity to plant seeds, and it might take them a while to mature, but what might be a loss in the short term isn't necessarily a loss in the long term. And I've kind of had my skin in the game long enough to see that be true, fortunately.
Totally agree. And I love that. I love that perspective that you have.
Thanks for bringing me on.
Yeah, thanks for coming on. Appreciate that. Going in that direction was nice. All right, everyone.
I kind of convinced her to come on because
Yeah.
she was blowing up the chat with some awesome questions and feedback. And so I'm really glad you came on, Aaron.
Thanks, Aaron.
Thanks.
All right, y'all. I got another event starting in 3 minutes. I got to prep and bounce and change up, but I appreciate y'all being here. Hope the deck was valuable. David, others, if you had feedback on those types of things that you wanted to continue to help me out as we continue to iron that out, would really continuously appreciate all the insights and feedback that you all have. So thank you for that. And we'll see you again next week. Can't wait. Thanks, everyone.